The corporate earnings results for Q2 FY21 have been better than street expectations. The sales growth, even though lower on a year-on-year basis, was also much better than estimates. Outperformance has actually come in the EBITDA. The expected fall in demand due to the pandemic and the shutdown prompted corporates to reorganize themselves and achieve a reduction in costs. The subdued input prices also helped. With the expected rise in GDP numbers from a contraction of 8% to 9% in FY21 to a growth of probably 5% to 6% in FY22, earnings may see an improvement. Nifty EPS growth has been weak and in fact it contracted over the last few years. EPS for FY21 is expected to contract due to the economic impact of the pandemic, but a recovery in GDP growth and corporate earnings is likely to help the recovery in EPS in FY22. The market valuations on trailing 12-month basis might look slightly expensive at this point of time, but the expected earnings pickup and EPS growth will help the concerns on valuation to gradually fade away. An interesting comparison is the trailing 12 months PE for the Nifty and the dividend yield index. The PE of the dividend yield index has been on an average at a discount or spread of 50% to the Nifty valuation. And currently the discount stands at close to 100%. The very fact that the average spread has been about 50% helps us to infer that this spread might probably narrow either by the moderation in the Nifty valuation or due to a rise in the dividend yield index valuations, the latter being the more probable scenario.